In this video, we discuss why investment compounding is still important in retirement. Coming up next on Holy Schmidt.
Holy Schmidt!
I've always been amazed at how the wall of financial information suddenly stops when someone enters retirement. Don't get me wrong, there are wonderful financial advisors out there who give great advice post-retirement, but magazines and online subscription services generally focus on what to do in your 20s, 30s, and 40s, maybe even in your 50s, but as you approach the day, they tend to disappear. Then the advice for the sites that do offer financial advice seems to focus on one of three things: asset preservation, meaning the shift between equity and fixed income product. You shift more into the fixed income product to minimize the effect of a bad market, something that seems to have escaped most retirees, unfortunately, over the last 6 to 8 months. The amount to withdraw annually from your investments, like the 4% rule that says you should take 4% of the value of your investments plus inflation and use that in your retirement cash flow. And finally, advice on Social Security. When to take Social Security. Can you work part-time and take Social Security? What about the spousal benefits? There are a lot of strategies around Social Security, but that is where the advice seems to stop. But there is so much more to be said and done around retiree finances, and as you know, that is the focus of the channel. Many of you have heard the saying from Albert Einstein that says, compound interest is the eighth wonder of the world. Those who understand it earn it, those who don't pay it. Attaching Einstein's name to the concept of compound interest seems to imply that it's very difficult to understand. But the fact is it's not. It just sounds that way when you talk about it in the manner that was just talked about. Basically, the concept of compound interest is quite simple. Your investments grow over time, hopefully, and as they grow, the earnings get added back to the base, and then you have a bigger base. They grow again, and those earnings get added to the base, and you have an even bigger base. As the base gets bigger, the earnings get bigger. If, for example, you had $100 and that $100 earned 8.5% per year, at the end of 1 year, you would have earned $8.50. If you didn't spend the $8.50, then your new base would be $108.50. When it earns 8.5% again, instead of earning $8.50 in year 2, you earn $9.22. Not a big difference, but that just means your new base is worth $117.72. Because the base keeps getting bigger, that means your annual earnings keep getting bigger as long as you don't spend those earnings. Over the course of 35 years, the base gets really, really big. 35 years is a long time, and if you add a little bit to the base every single year and don't spend any of the earnings, you turn $100 into $1,885.79. After 8 years, your investment doubles. Your $100 becomes $200. After 8 more years, it doubles again. Your $200 becomes $400. 8 years, it doubles again. $400 becomes $800, and so on. And at the end of the 35 years and all of that doubling, your original $100 is 19 times bigger. But for some of you, this is math. You understand how it works, but I would say for a large portion of you, the magic is in the fact that the base gets bigger and you don't spend the earnings along the way. Since you have nothing but time when you're young, it grows into a mountain. 35 years, in fact, it grows into a mountain. And at the end of 35 years, you're approaching retirement. Now imagine instead of $100, it's $1,000 or $10,000 or $100,000 over the course of a decade or so. It becomes a very big number. That is compound interest in a nutshell. That very big base forms your investment mountain in retirement, and this is where the textbooks, magazines, and websites go blank. This is because many of them don't know how to explain the next part. Up until this point, the textbooks and financial advice says that as long as you don't spend the growth, you're going to build a bigger and bigger base. But when you go into retirement, you need to spend. That's the purpose of saving for retirement. In fact, most retirees don't only spend the growth, but they also spend part of the base. So the base starts to get smaller. But the important point to note here is that a dollar doesn't stop working when you stop working. It doesn't sleep into the day. It doesn't get out of shape. It doesn't lose energy. That same dollar has the same performance power whether you're in retirement or not. It's just how you direct it to perform. It keeps working the way it always has. It keeps compounding. In fact, if it didn't, retirees would run out of money very, very quickly. So when you retire, you don't simply take your retirement base, your retirement assets, and divide it by your expected lifespan. For many of you, you have 30 plus years of investment performance left. Now let's say you retired at 65 and expected to live to 100. That's 35 more years. But at age 65, your dollar needs to work differently. It still works just as hard, but it works more consistently. Because it's working more consistently, it's not seeing the big returns because you're not taking the big risks. Still, you're deploying it in a way that generates capital, additional capital that you can spend in retirement. This is because your investment mix starts to change, of course. If you had been in equities the entire time, let's say the S&P 500, from the time you were in your 20s to the time you were 65, you would have received about 12.5% return. But most people don't have a pure index fund investment strategy. They add money market funds, which tend to bring down the returns significantly if you have a lot as a percentage of your overall portfolio, or they have bonds, or some combination of money market bonds and equity. That's how we came up with the 8.5% number. But strictly speaking, had you just been in the S&P 500, you would have received about 12.5% over the last 35 years. But those going into retirement don't want to take pure equity risk anymore, because that base that had grown to be that mountain now needs to be used for other things. And if it's all in equity and you have a few bad years, you're going to be depleting your base very, very quickly, because you are in fact using the investment returns and part of the base. So your dollar goes to work differently, still working, but it goes to work differently in retirement. Sometimes you invest in bonds, which have coupons. Sometimes you invest in stocks that pay dividends, stable dividends. They can, of course, get cut. It has happened in the past, but generally dividend stocks are more stable than growth stocks in terms of expected return. And of course, money market funds and other short-term investment products that pay some type of interest, not much, but some. Because coupons and dividends continue to pay in good times and in bad times, it's reasonable to assume that you're still going to get some level of return in retirement. In fact, it's necessary. For the purpose of this discussion, we're going to assume that is 5%. I don't think that's overly optimistic. It's also not one that a lot of retirees feel uncomfortable with. It's less than 12%, 8.5%, and in fact, either one of those numbers retirees generally feel uncomfortable with, the ones that I talk to anyway. It's a much more rational number for someone in retirement who is going to be spending down their base. So without compound interest, assume that you took that same $1,885 and you just put it in your checking account and divided it by 35 years. $1,885.69 would pay $53.88 per year, assuming no return. Now, $53.88 is not bad for a $100 investment, particularly if it's paid out over 35 years, but you can do so much better. If you take that same $1,886 and invest it at 5%, you will receive $115.16 per year. More than double what you would get if you didn't continue to invest and get compound performance on your investment, albeit at a lower performance level. And for reference, if you just put your $100 into an S&P 500 index and let it run for 35 years, assuming 12% return a year, your $100 would be worth $5,913, 3 times as much as the $1,885.69 that we talked about before, which also means that your cash flow in retirement at 5% would be 3 times as much, meaning $361.15. If you like this video and you'd like to see more of me, please make sure you click subscribe and turn on notifications so that you get alerted the next time I post a video. I post about twice a week. Also, check out my last video on 5 things that will make you financially secure in retirement. This is Jeff Schmidt. Thanks for watching.